from Gautam Khanna with TD Cowen. Please go ahead.
Good morning. This is Liz Husseinov on for Gotham. I was just wondering if you can provide any detail about order trends in the quarter by aero end market, for instance, fasteners versus engines versus other structures.
Yes, good morning. I'll take that question. Aerospace engine sales were up 43% year over year, down 8% sequentially. So even though down 8% sequentially due to the items that we noted in our prepared remarks, the quarterly shipments are about 90% of pre-pandemic engine ship rates. So bottom line is that engine sales remain strong and we're oversubscribed, and the ramp pushed as the ramp pushes demand even higher, well beyond pre-pandemic levels. On fasteners, sales up 77% year over year and down sequentially about 13%. Same story there as engines. So hopefully that's helpful.
Yes, thank you. And then is there any incremental weakness to demand in non-aero markets given the macro?
Well, certainly you've heard commentary out there in the market around the general industrial market, and I can comment on that. That's a limited portion of our sales that's used to support that general industrial activity. Those trends are not material meaningful to our bottom line, as our focus is really on high value, difficult to manufacture products, where demand is currently outstripping supply by quite a bit. So as you know, our portfolio consists of premium high value products, and any type of weakness in those sub-markets will not impact our bottom line materially in the short term or the near term.
Okay, thank you. And then just one more. Can you give any color on which work centers have the most opportunity for productivity gains?
Yeah, it's a good question. It's a really good question. The biggest driver certainly is on the front end of our process, which is the primary melting areas. There's a lot more productivity and output we can get from those. So that's the major driver. But also on the back end and finishing, if you think outside of SAO and look at Dynamet, for example, their biggest increase in productivity is on the back end and some of the finishing pieces. And in fact, we've got a couple pieces of equipment that will be installed here in the near term that could see Dynamet's profitability or operating income, much like SAO, go up as close to 50% higher quarterly in the second half versus the first half. So there's a lot of areas that we're working on. I think the good news is that we're able to achieve these very high levels of operating income, knowing that our business is still not operating at 100%. So from a shareholder standpoint, there's a lot more that we can do to drive profits even higher.
Okay, great. Thank you.
Thank you.
The next question comes from Josh Sullivan with the Benchmark Company. Please go ahead.
Hey, good morning, Tony, Tim, John. Congratulations on the quarter here. Just on the base price increase on the non-contract alloys, is there a way to think of percentage or capacity that's available for that transactional business at this point? And then in previous cycles, where aerospace was consuming more of your capacity, what did that mix shift look like for the non-aerospace markets? And I'm just curious to hear how those non-aerospace markets are responding this cycle versus historical cycles.
Well, let me see if I can tackle that question for you. Certainly in this cycle here, aerospace and medical are the ones driving the quickest for us, and that makes up well over 75% of our revenue. Some of the other markets, for example, like energy, is single digits for us in terms of percent of revenue. But again, for them to get time on the mill, we're seeing prices move up significantly in the energy side where they challenge aerospace type prices. And that's what it takes for us to be really interested in those types of products. So obviously our main focus is on the aerospace and medical, Josh. And I would say if you compare it, as you asked, to prior cycles, the amplitude of this ramp is significantly greater than in prior cycles.
Got it. And then, Tony, you spent some time there just talking about, the fiscal 27 targets and the front-end loaded nature of how the guidance is put together. But as far as the back end of those targets, is there any reason we would think to plateau there, or is it just conservatism on your nature?
Well, we've heard that. I thought I'd get a question on this, Josh, and if you let me kind of go on for a little bit to kind of put all that in context and then come back to your question. I spent some time last night and I was thinking about what we've really said over the last couple quarters. And as you well know, you were there, this all started in May of 2023 when we had our investor day, right? Where we said we were going to double operating income FY19 versus FY27, which was one of our most profitable years, by the way. 40% CAGR from 23 to 27. As you mentioned, we said it wasn't going to be back-end loaded. It was going to have meaningful cash generation, and we didn't need to make any large-scale capital expenditures for capacity or M&A to get there. We come out with the fourth quarter, and we actually exceed our target of getting to FY19 run rate profitability. So that's a big check mark. During that fourth quarter, so about 3 months ago, we said that this first quarter was going to be slightly down to flat, and we was going to, bust through the normal seasonality where you see the first quarter being sequentially down. And as you well know, we had a lot of people doubt us and say that you couldn't do that. Well, we actually exceeded that number. And now we come in and say that the second quarter is going to be another impressive quarter, just like Q1, even though we'll continue to do our planned maintenance, even though it's got 2 major holidays in there, we're still going to operate at that level. And then what you're getting to, the new piece of information that we came out with today, we said that even after those 2 quarters, put those together, and we're going to do another 28 to 35% on top of that. It's very impressive growth, and that's why we took the time, Josh, to talk to you about that some of these work centers are still not running at the rates that we know they can run at. That's how we have line of sight to that second half. Again, we said it wasn't going to be back-end loaded, but we never said that we were going to get 50% in year 1 of 4. And I think your question is that's an awfully strong comment. We've heard now, does that mean that years 2, 3, and 4 could be even more? And is there some conservatism put in there? And you might have a point. Maybe there probably is a little conservatism in there, and we have the ability to even push that higher.
That's right. Great. No, thank you. Thank you for that. And just one on the productivity side of that. You think Carpenter's doing anything different on the labor side in those work centers, or do you think it's just a natural factor of time and experience that they're getting better?
I don't know if we're doing anything differently. I mean, we have to be very, I'll use the word cautious, right? Because we are producing products that can never fail, a very high quality standard. So we just don't take chances. If an operator's not ready, they're not ready. And we don't push them to put them in a situation where we could sacrifice the quality of our product. That's just unacceptable. I'll give you a couple numbers that are interesting. If you think about a new employee that's been with us 2 years or less, and if you look at our SAO operation, our plants range anywhere from 30 to 60% of our shop floor workers have been there 2 years or less. In our Dynamit facility, we have one facility that 50% are new in the last 2 years. The other is almost 30%. That is a big influx of new employees, highly qualified. I mean, the level of employee that we're attracting is very high, but it's a complex, very sophisticated equipment that we're going to make sure they can operate it, number one, safely, and always within the quality standards that we hold ourselves to and that the industry requires. So you've seen some nice improvement over the last couple of quarters. The good news is there's still more improvement to come. Hopefully that answers your question.
Yes, yeah. Great. Well, thank you. Again, congrats on the quarter, and thank you for the time.
Thank you.
Again, if you have a question, please press star, then one. The next question comes from Chris Olin with Northcoast Research. Please go ahead.
Hey, good morning. Congrats on the quarter, guys.
Hey, Chris. Good morning.
Just wondering on the near term, has there been any type of negative volume impact associated with the drop in the commodity nickel market? Just wondering if some customers will delay orders or you're seeing any of that because of the surcharge visibility, or are we at a point where like the long-term behavior has kind of changed when your customers are worried about supply?
I think it's the latter, right? And I know we're not having any customers delay orders because of where the nickel price is or where they think it's going to go. I mean, we have all of our customers trying to get into the order book earlier, right? As you know, we've closed the order book a couple of times. So that comment that you just made, just in this type of environment, does not, it's never made. It's never discussed. That's not a factor.
Okay. I may have missed it. I apologize if I had, but I was just thinking about the pricing dynamics and your comments about the increases. I was just wondering if there are contract renewals on the horizon yet. I can't recall from the last quarter.
Yes, there are. I mean, over the last couple of years, obviously by our results, you can tell that we've had contracts that have renewed, and now you're seeing that higher price come through. And there are a couple more that are in the works as well. So it seems like at any point in time, we have one or two that we're working through, and there's a couple significant ones that we're working through as we speak.
Is it safe to assume something like 20-30% renews price each year for the model?
Let me make sure I understand your question. Are you saying that 20 or 30% of contracts renew every year?
Yeah, we'll renew at a higher price, so I could put that in my...
Well, all contracts are renewing at a higher price. That's something that's that's consistent across the industry. You can take that with a high level of confidence that all contract renewals will be at a much higher price.
Okay. Just last, wanted to shift quickly back to Dynamet, and guess I'm thinking a bit about the Boeing 787 and the A350 build rate increases, kind of the peak outlook, and I can't recall if Dynamet is levered to one platform more than the other, and would you benefit kind of significantly from a doubling of the production targets? And I guess lastly, do you have enough capacity to satisfy that if you do?
Well, to answer your last piece of your question first, no, there's not enough capacity in the system across multiple sub-markets. For us, we sell to every one of the fastener companies, so whether it's Boeing or Airbus, in this type of demand environment, when demand is so much higher than supply, that's just not a factor. We're oversubscribed, and we anticipate that being like that for several years to come, regardless of the split between wide body and single aisle and Boeing or Airbus.
Would a capital investment be on the horizon for that to adjust?
Possibly. I mean, Dynamet, just like SAO, is working to get up to rates as well. We're not running in Dynamet at the level we need to run at. And on a previous question from Cowan, I said that, in fact, we have a couple pieces of equipment that are coming in here in the near term into Dynamet that will increase our finishing capacity. So that will help as well.
Okay, great. Thanks so much.
Yeah, thank you, sir.
The next question comes from Michael Leshock with KeyBanc Capital Markets. Please go ahead.
Hey, good morning. I just wanted to ask here on volumes. We saw a decline in the quarter given the less shipping days, but looking forward, how do you see volumes increasing relative to price and mix? So if your long-term guidance incorporates a 15 to 20% increase in volumes above fiscal 19, do you expect that volume uptick to be largely in fiscal 24, or is the big step up this year more so a function of price and the volume piece is more linear over the course of your long-term guidance?
Well, the volume is going to follow our productivity for the most part. I mean, as you've seen now in this quarter and into next, a big part of our strategic mix management is moving that volume around. Because some of the products, as we move to different types of products, they take longer to process through the system, right? Especially like in a primary melt product, it could be melted 3 times. That just takes longer to go through the system. Much higher margins on that, but it takes longer. But as you see our productivity continue to increase, as we've talked about, as some of these other pieces come online, certainly volume will be higher in the second half than the first half.
And then on maintenance, were you able to get all your normal seasonal maintenance spending done, just given the lower CapEx spend sequentially, and maybe running your assets above normal seasonal utilization levels? Or do you see any spilling into the second quarter?
Well, we're in perpetual preventive maintenance. The days of shutting your plant down for 3 weeks and turning everything off and sending everyone home and doing all your preventive maintenance are over, right? That's not the most efficient way. We are always in a cycle of preventive maintenance. And you know, I think, you know, I've been asked, why do I talk about this? And, you know, when you're in a situation where supply can meet demand, you know, certainly no one really talks about preventive maintenance. But when you're in a sold-out environment where any amount of downtime will translate to customer impact and the amount of product you could ship, well, then that's why it makes it important. That's why it's important to say at any point in time, we're going to be doing that. Secondly, I would say it's really important to remember, Mike, we have really exclusive, highly sought-after assets, and it's our job as skilled operators to protect that equipment, obviously, over the long term. So we're aiming for a 40% CAGR, annual CAGR over the next 4 years. That's our goal. Our goal is not to run the equipment to failure simply to earn a couple more $1 million on top of already a record quarter, right? So, I mean, that would be unprofessional. So it's not about trying to, let's run it more and try to get out another couple million. We're in for the long haul where we're going to, you know, double operating income versus FY19 over 4 years. So we got to protect our equipment and treat it the right way.
Got it. Appreciate all the detail.
Thank you.
This concludes our question and answer session. I would like to turn the conference back over to John Hewitt for any closing remarks.
Thank you, operator, and thank you, everyone, for joining us today for our fiscal year 2024 first quarter conference call. Have a great rest of your day.
The conference has now concluded. Thank you for attending today's presentation. You may now disconnect.